going to be covering a little bit of everything. We're 9 months into the year, and year just flew by. So we still have 3 months that we can get ready to close out this year and get into good habits for next year, 2026. So just like in late night TV, there's always like a top 10 list. So I have a top 10 list of positive habits that everybody should be picking up as we go along. I'm going to go through the importance of building wealth and leaving a legacy. So, not only building wealth so that you can accomplish all of your goals currently, but also leaving something for your family. And we're going to go through habits that will help you shape your personal and your financial future for yourself and for your family as well, with that legacy that you're leaving. And I want to do it as I've always done it, interactive. So any questions, please bring them up as I go along. And let's jump right into the first habit. Live below your means. So it's basically prioritizing your needs over your wants. And I'll go more through the needs and wants in a couple of slides later when we're going through the budgeting aspect of it and avoiding lifestyle inflation. So what's lifestyle inflation? Lifestyle inflation, also known as creep inflation, is that as your income increases, a lot of people will spend more just because they have that extra income. What financial planners, accountants, and investment gurus like to do is they like to help you in investing or in using that extra money that you have as income to pay down current debt so that that can actually give you much more financial freedom than just getting an increase in your salary. So when you get a salary increase or you're performing a side hustle where you're making extra money, instead of using that to spend, just use it to actually pay down any debt that you might have and to increase your emergency fund, increase your savings funds. So that avoids that lifestyle inflation, which is basically as income goes up, your expenses go up. And that shouldn't necessarily happen. It can if you have a family where you want to expand, get a bigger house, you have more kids, then I can see your income kind of leading to an increase in expenses. But normally, we don't want to do that. We want to keep that extra income to apply towards savings and apply it toward reducing your debt. That's one good habit to always look at prioritizing what you need, which are your very important expenses that you need to have, as opposed to your wants, which is just an arbitrary or a discretionary spending amount that you have, and avoiding lifestyle inflation. Habit number two, which I always bring up in most of my presentation, is paying yourself first. Automate a savings or an investment portfolio at all times in order to have an emergency fund for a rainy day in case of an emergency. You should have anywhere between 3 and 6 months of expenses saved in case of you lose your job, you become ill, you get an unexpected expense, you have an issue with your car, tires, engine blows out, problem with your home. If you own a home, you might wind up with your burner. Uh, where you do not have to rely on a credit card in order to be able to get through that expense. If you have savings, you apply it, and it doesn't really disrupt your financial pattern, uh, and it doesn't get you into new debt. So automate savings and investments with the pay yourself first. It's also a certain percentage of your salary you should be putting away into a savings account, which can be a high yield savings. You can put it into an investment account, and that's part of your emergency fund as well. Any questions so far? So, as part of the second habit, and even the first habit, the best way of paying yourself first, the best way of creating an emergency fund, creating a savings account or savings fund, an investment fund, prioritizing your needs over your wants, and avoiding any lifestyle inflation would be to have a budget in place. And there's three different budgets that I'm going to go through briefly. These are the three most popular ones, and people sometimes do one of them, sometimes they do a combination of these. There's a 50-30-20 budget model, which in New York, it's more like a 65-20-15. The 50 represents living expenses. That will include rent or mortgage, utilities, groceries, health insurance. These are the non-discretionary amounts that you need to spend. So in some parts of the country, 50% of your net income will cover your needs. In New York, with the living expenses being so high as far as rent or mortgage and utilities, that 50 might be more like a 65, even a 70%. Um, the 30 in this scenario is your wants, and your wants are discretionary expenses. Those are the expenses that are non-essential. That'll be like eating out, doing takeout, streaming services on TV where you have three, four different streaming platforms, which are not really necessary because there might be some duplication, and we'll go through that later on. Some hobbies, hobby expense, and even shopping above and beyond your groceries and needs that you have. The 20% is the savings and debt repayment. So this portion is dedicated to your financial future. And it's a shame that it's usually the smaller amount because you need to spend more on your needs and your wants. But at least having 20% going to savings and debt repayment is the recommended percentage amount. This is dedicated to your financial future, like I said. It includes building an emergency fund. It includes savings for your retirement. And it also includes making payments on debt that are beyond the minimum amount that's required. So the 50%, let's go back to the 50%. The 50% is for your needs. Your needs include the minimum payment that you need to make on credit cards. So if you have credit card debt, as part of your needs, which is non-discretionary, it's mandatory, you need to spend that. You need to make those minimum payment amounts to your credit cards. If you have extra amount of money left over, that goes under your 20%, and then that extra amount, you can apply it as an extra payment on those credit cards. That way you're making the minimum payment plus an extra payment if you can have an extra amount that you can swing that way. So that's the first budget method, 50-30-20. It might become in New York a 65 or even like a 70 for your needs. And then your wants would be anywhere between 20-25%. And then your savings piece could be 10-15-20%. As a minimum, there should be at least 10% of your net income going towards savings and extra debt repayment. Any questions on this method so far? Okay. Um, I want to note that in all three budgeting methods, you would be using your net monthly income, not your gross income. So the amount that actually gets deposited into your bank account after your taxes are withheld, insurance, medical insurance gets withheld, and all your other payroll deductions. That amount is what you work into your 50-30-20 budget, or the next method, which is the zero-based budget. So a zero-based budget basically assigns a purpose to every dollar that you have. On the 50-30-20, you're applying a percentage. So you're saying 50% your savings. But on a zero-based budget, you're actually dollar for dollar designating what each dollar of your net income will be applied to. So every dollar gets allocated to an expense. There is no positive amount left over, so it's not like you have an extra amount. There shouldn't be a surplus or loss because you applied something to everything. You applied a dollar to every left over. If you were to do the zero-based budgeting, you would immediately apply that $20 towards savings or paying down debt by making an extra payment in addition to your minimum payment due. So with zero-based budget, you don't have any surplus and you don't have anything, any losses at all. So it's no surplus or loss. You wind up with a zero budget. So if you get a net income after all your deductions deposited into your account of $4,000, by the end of your budget, you should have spent that full $4,000 between your wants, your needs, and your savings. So essentially, once you've paid all of your wants, your rent, mortgage, utilities, things that you need to spend on, once you've spent on your wants of what you need, on your wants, like you're going out, and the other discretionary expenses, any amount that's left over should be allocated to savings. So you're not going to wind up with extra money left over because any extra amount that you haven't spent, you should automatically allocate to a savings and increase your emergency fund. Any questions on that one? And these are just suggestions. Like I said, some people use these as a rule. Some people do a combination of each. They kind of merge a few of them. They do it in a few different ways. And then we have the third methodology, which is the envelope budgeting system. Um, in this case, you either do a combination of the 50-30-20 or the zero-based budgeting. But what you do is you actually take the cash and you put it in envelopes. So you will wind up with a certain amount of money in an envelope for your needs, a certain amount going into your wants envelope, and then a certain amount going into your savings envelope. Sometimes it's kind of awkward because the savings, you should probably just leave it in the account or automatically transfer it to a savings account or an investment account. And then what's left over will be your wants and your needs. But what the envelope does is, let's say that you've allocated a certain amount to your wants, and you have a little list, and that says that you plan to eat out or go out dining or do takeout, let's say once a week for $50 a week. So you set aside $200 for that. Let's say that you wind up going out, but you wind up spending more than the average $50 a week. Once you spend the $200 that you had laid out for dining out or takeout, you cannot spend anything else, which means that you will not go out or you will not take out, and you cannot borrow from another envelope to make up for that shortfall. So the envelope will kind of hold you to your number that you set. So it's a little bit more rigid because it's not, it doesn't give you the opportunity to use your debit card or your credit card. You're limiting yourself to the actual cash that you have on hand in the envelope. So these three methods, or a combination of the three, will help you get a better understanding of what your expenses are, how to allocate your income to cover those expenses. It helps you balance or manage your finances in a much better way because it's more visual. So it helps you ensure that you're not neglecting something that's essential or a need. You're not neglecting your savings because you are allocating a certain amount to your savings. It helps you develop responsible habits in your spending because it'll show you that you're spending too much in one particular area that you probably should not be spending that much. or that you're not putting enough into savings, let's say, or that you don't have enough money at the end of the month to make the minimum credit card payments. That will definitely help you keep track of your spending and make sure that the amount that you're getting, your net income, is being spent correctly and allocated accurately and adequately. Any questions on these methods?
With the slides.
Okay, great. Thank you. So to summarize the budgeting piece, the benefits of the budget gives you financial awareness. It helps you with your debt management. It helps you in reviewing what your uh, payment methodology should be. If you have credit cards, it'll help you pay them down as quickly as you can. It'll help you achieve your goals that you have. Having a budget will be like your roadmap, so you can achieve whatever goals you have or aspirations that you have. And it'll help you definitely in building up an emergency fund, which is important for everybody to have. The third habit is investing early and consistency in those investments. So retirement accounts like a 401k, an IRA, or Roth IRA, uh, you should invest in those as early as you can in your career. If you're self-employed, always look at IRAs, look at self-employed IRAs or SEPs, which are self-employed retirement plans. Starting them early gives you the benefit of compound interest. So compound interest basically is the interest that you earn or the dividends that you earn on an investment. Those that interest and that dividends will earn future dividends and future interest. So you have $1,000 in an account, and at the end of the year, you earn, let's say, 10% return between dividends and investments. So now at the end of the year, you have $1,100. January 1st of next year, now you have $1,100 working for you, and that $1,100 will earn whatever percentage you earn that year between interest income and dividend income. So the the more growth you wind up having because of that compound interest. Because not only will your principal earn income, but whatever you have earned so far will continue to earn income as well. So it continues to snowball bigger and bigger. And doing it consistently is also very important. Um, Having a lump sum at one point is fine, but the best part would be to, as part of the budget that we just covered, making sure that you always have every month or every week, depending on how you get paid, every 2 weeks, to have a certain amount, certain percentage of your income, your net income, being put aside into an account and doing it consistently to increase your savings. Habit number four now deals with the other side of the equation, which is managing your debt. So the first couple of habits were how to manage your income, how to allocate your income. This one is actually addressing the actual debt. So you have good debt and bad debt. Good debt is usually debt that you've acquired in return for an asset that is building up either capital gains or through the market value, similar to uh, a house. So a house will have real estate value, which historically has always increased. So having a mortgage is considered a good debt because you're getting something out of it. Having a car loan is a bad debt because the car loan depreciates. The car loan continues to be paid on a price that was set at the time of purchase, but the value of the car continues to depreciate. And you can potentially get to the point where you're considered underwater, which means that you now owe more for the car than the car is currently worth. And that usually happens when you take long-term car loans, because at the end of 5 years or 7 years, the car is not worth what you're still paying for it. So looking at the type of debt that you have and trying to manage it wisely is very important for your long-term financial stability. And you should be paying off higher interest debt first. There's um, two very popular methods in paying down credit cards, and usually also personal loans, debt loans. Uh, and those are the debt avalanche and debt snowball. So the debt avalanche method, you would pay the minimum amount on all your debt. Any extra amount that you have of money left over, you would then apply it to the debt that has the highest interest rate. So debt avalanche pays off the one with the highest interest rate first. Once that gets paid off, then it moves on to the one with the next highest interest rate. Then there's the debt snowball method, which involves making minimum payment on all your debt and then paying any extra amount that you have to the smallest debt first. What that does is it gives you that rewarding feeling that you paid off one bill in total, and then you move over to the next one. So both methods are good. One is more of a psychological gratification method. The debt avalanche is the one that makes more mathematical sense because you're actually saving interest in the long run. So listing your debt based on of what your debt is and how the interest rates are calculated and how high the interest makes your debt become. Just like I said earlier with the compound interest, the same applies on the debt side. So the more debt going up because of the interest payments that are not being made or interest rates that you are accumulating. So one of the habits that we should all pick up is how to eliminate and manage your debt wisely. And using that strategically, like I said earlier, real estate. So a mortgage is a good debt because you have a property in exchange for it. Business loans are good as long as the business is creating positive income and it's fruitful. Habit number five, I've gone through in other chats as well. And it's basically diversifying your income, looking for multiple income streams, not depending so much on one paycheck. So essentially what you would do is try to get some type of a side hustle, um, some other method of building wealth by a second job or a second source of income. Sometimes investments do that as well. Large investments or investments that pay off very well can become a second source of income. A good habit also to have is protecting your assets. So once you have, let's say, a house, car, or a business, you have to protect all your assets, which would be with insurance. So life insurance protects your income. If you were to pass and you have life insurance, your family will receive an amount that would cover what you would be bringing in as far as the income, and it helps the family for a certain period of time, get back on their feet financially. Uh, Health insurance helps you in maintaining a certain lifestyle, a healthy lifestyle, which would allow you to continue working where you can continue to make money. So health insurance is very important. Property insurance on a house, any type of an investment property that you might have, or a car, it's also important. And disability insurance is good because it protects you in case you get injured and you're not able to work for a certain period of time. Disability insurance policy will cover part of your income that is lost in the meantime while you're recuperating and in rehab. Estate planning, that's for end of life protection of assets. So by having a will designating how you want your assets to be distributed is very important. Having trust accounts, if there are any minors that you plan to leave any assets to, that's also very important. Having power of attorney with somebody that you can entrust to carry on your wishes if you become incapacitated or something would happen where you can't make a decision as far as what to do with your investments, how to continue helping your family with your investments and your accounts. So power of attorney is very important as well. A power of attorney ends when the person passes away. So power of attorney is only during the lifetime of a person because you've designated somebody to help you under certain circumstances to act on your behalf if you cannot. But if you hand with the debt repayment, it goes building and preserving your credit. So maintaining a strong credit score by making payments on time, making at least the minimum payment, if not more, reducing your use of credit. There's one of the elements that's used in computing credit score is debt utilization. So let's say you have multiple credit cards and in total your credit limit for those all those cards is 20,000. And let's say you owe 15,000 in total on all those cards, you have a 75% debt utilization, which means that you're using 75% of the available credit. Credit agencies look at that in a negative manner. They usually want you to be using because it shows that you're managing your debt correctly. So the debt utilization is a very important number that helps you maintain a strong credit score and a high credit score. So try to keep your credit card debt as low as you can. If you do hit a point where it's extremely high, it could have been because of an emergency of some type. Make sure that you start paying it down as quickly as you can so that your credit score can recover and can start going up when your debt utilization comes down. And using credit strategically, that's uh, similar to what I just said, making sure that if you do have a high amount of debt as compared to your credit limit, that you start paying it down as quickly as you can. And another method of using credit strategically is if you have the cash to make a large purchase, you can use the credit card, but make sure you pay it within the 30-day credit cycle for that credit card. So it'll show that you had a big purchase, but it'll show that you paid it down immediately. That will also give you a bit of a bump up on your credit score. So using it strategically, making sure you have the cash and using the credit card to pay it, and then pay off the credit card. That helps you because it shows that you're using your credit limits um, in a very savvy way, and it shows that you're managing your finances very well as your debt. Any questions so far on anything that I've covered?
Yes, Oreo, we have one in the private chat. Can you talk a little bit about credit cards and like ones that have points and like ones that give you cash back and the difference and which one you would recommend better?
Sure. So there are credit cards that just give you a credit line, period. There are credit cards that give you affinity points, so you can have travel points that you can apply toward travel tickets. There are some that give you cash back based on what you're purchasing. There's some credit cards that actually have what I call the rate of the month. So one month they'll say we'll give you 2% on groceries that you might purchase this month. Some other cards will say this month, if you have any car expenses, like tires or car repairs, we'll give you 5%. Or they'll do specific um, they'll give the credits for specific stores. So if you go to a particular store, you purchase a particular item, they'll give you a higher return or a higher cash back. Those cards are all good as long as you pay them on time. And essentially it'll be what I said earlier, where make sure you have the cash to buy it in cash. But if you use the credit card, make sure you pay it off within the 30 days. Because if you wind up using a credit card for it, because you're paying the higher interest on that particular debt. So I recommend able to pay them off within the 30 days of that particular charge. Otherwise, the bonus that you're getting back is not worth it because you're spending it in the interest rate that you're paying by going over the 30 days or going past the payment cycle for that card. Uh, but otherwise, they're great. I know people who use the cards, they pay them off and they wind up getting these cash backs and accumulate it. And sometimes they even use the cash back to pay the card itself because you can apply it to the card itself. Or they pull the cash out or whatever credit they got and they take advantage of it. They go on a trip, they wind up getting an extra ticket, airline ticket paid off because of it, or they wind up purchasing something, even if it might be like frivolous, but it didn't cost them anything because they got it for free. But make sure that you do pay off the card within that payment cycle. Otherwise, those credits and those benefits, did that answer the question? Anything else, Hema?
Yes. Can you just talk a little bit about credit unions and how they differ from banks?
Sure. So banks are publicly held companies for the most part. Credit unions are financial institutions that are basically run and owned by the members. So if you have a savings account in a bank, you'll wind up getting interest. If you have a savings account in a credit union that you're part of, you wind up getting dividends because you own, but when you deposit money into a credit union account, you're basically owning part of the credit union because you're a member of the credit union. Some credit um, give much better benefits to those members because they give them preferential interest rates on loans. They approve loans for cars, mortgages, and credit cards much quicker, and the interest rates are much lower. Their overhead is less. Their cost to run the credit union is much less than a regular bank because they have smaller footprints. Credit unions are not like banks that will have 1,000 branches. Credit unions will have a handful of branches. So their overhead is much less and they can pass along a lot of those savings to their members in the way of lower interest rates and preferential loan acceptances and rates. So you basically own part of the credit union, you're a member of it, and you're a part owner of it. Whereas in a bank, you're just an account, a number. Banks are protected under the FDIC, so they have government backing if there is any type of default on the bank. And credit unions have an equivalent to the FDIC, uh, which is the National Credit Union Fund, and there's another letter somewhere in there. Uh, and they're also protected. So if the credit union does go under, the federal government does cover as well. So as far as the benefits and the protections, you get the same protection in a credit union as you do with a bank if there is any type of fraud or default, but you get much better benefits from it. And that's something that people should look at if based on the type of job that they have, they're eligible to join a credit union. There's a lot of credit unions for teachers. Government employees have a few credit unions at the local, state, and federal levels that they can take advantage of. And if you do a comparison with the credit union that you're thinking of joining or that you're part of and look at the rates and the benefits, yeah, compared to a bank, you'll see that it's much better to be in a credit union than in a bank. So I do recommend credit unions. They are very good financial institutions.
So we have another question in the chat. Thanks, Oreo, for giving such a thorough explanation. We have a question that says, what percentage of available credit is a healthy debt?
The credit bureau that's looking at it, there's three major credit bureaus. Some look at 15% to be a good amount of credit utilization. Some look at up to 25 to 30. If you're going for a mortgage underwriters will look at, I believe it's about 20 to 25% of your debt to income ratio. So it depends on what the purpose is. If you're going to go for a loan, for a mortgage, for a car, or even for a credit card, um, different reviewing institution, different underwriters will have a bit of a difference as far as the amount that they consider to be a healthy amount of debt compared to your income and your credit. And that'll range anywhere between 15 and up to 30 max. Uh, Conventional wisdom for a lot of financial planners is that anything over 20 is not good. So you should keep your debt um, less than 20. And that is the what I consider to be the bad debt. So credit cards and car loans should be less than 20% of your overall income or overall credit available. Mortgages are always over 30 because if you get into a 300, 400, $500,000 house, you wind up with a fairly big loan as compared to your income or your credit utilization, but that's considered a good debt because you have the backing of the property to support the debt. So not counting mortgages, just counting bad debt, which is credit cards and auto loans, I would keep it at less than 20%.
Great. We have a question about mortgages. How can we reduce the mortgage? Is there a way like you can pay extra against like the principal that's owed? And can you talk a little bit about that?
Sure. 99% of mortgage holders of financial institutions that have mortgages will allow you to make payments toward principal. There's one method, and lately I've noticed that a lot of banks are not allowing it, where instead of you making monthly payments, you will make biweekly payments. So instead of making 12 payments for the year, you're making you wind up making 13 payments because of you doing the biweekly, and that extra payment usually gets applied to a principal. At any point in time, you can call the bank and you can say, I want to make an extra payment of X amount. and I want it to be applied only to the principal, and the banks should honor that. Some banks, they'll allocate it and they'll say we have to allocate a portion of it to interest and a portion to principal, which really changing the rules as to how they apply payments, but you always have the option of making extra payments. The trick is to make sure that you notify the bank, I'm making this extra payment and I want it to be applied only to principal. So what happens is they apply it to your principal and your principal amount goes down, but your initial mortgage was calculated and amortized on 20 years or 30 years. So your monthly payment will still be the same, but your principal is now lower because of principal payments that you've made. So you're going to wind up paying your mortgage much quicker, even though you're still making your same monthly payments. So if you do large lump sums uh, of payments and you apply them to principal, look at your yearly statements from the bank, or even like a monthly if they send it to you, or quarterly, and look at the principal amount, and you'll see that the principal is going down. So you're going to wind up paying it in less than 30 years. You might wind up paying it in 25 or 22 years, but keep track of the payments that you're making because your monthly payments will still be the same amount. That amount would not be recalculated to calculate a new payment based on a new principal amount that is owed. So I know people who have done that and they've paid down very quickly. And then all of a sudden they realize that they only have like 10 years or 15 years left. So their monthly payments will continue, but it'll end much quicker than they expected it to because of that. So yes, you can apply extra payment going forward because you're once you do that, you're not going to be making payments for 30 years. Your time period will start getting shorter and shorter. That was a good question.
Can you talk a little bit? Does it work the same way about car payments too?
No, car payments, if it's a variable rate, sometimes what they will do is they'll allocate the payment. So let's say your car payment is $500 a month, and that includes the interest plus the principal. And you wind up sending $2,000, they won't apply the 2,000 for the most part. They will not apply the $2,000 to the principal amount of the loan. They'll apply the $2,000 to payments. So they'll say you just made 4 payments in a row, and then that'll cut down your payment schedule, but you'll still wind up paying the same amount on a monthly basis. It'll ultimately reduce your interest that you paid, but they allocate it to a payment. So it'll show that you just made payments on 4 more months in one lump sum.
Great, thanks,
Any,
Oreo.
you're welcome. Thank you. Good questions. Questions. Okay, so let's see. Habit number 8, educating yourself and your family. Um, Having ongoing financial literacy like we do every month in the library, we have a Zoom or we do it in person. We pick a topic and we go through something. Doing this on a regular basis gives you tidbits, gives you nuggets of information that you can use to keep track of your finances, to budget yourself, to invest wisely, to save for retirement, save for emergency fund. Always do that. Um, Listening to YouTubes on investments, listening to Bloomberg or CNBC, uh, reading financial related periodicals and magazines give you some information. Always continue the financial literacy, always learn. about debt, about income, about the economy, what's going on with the interest rates. Are they going to go up? Are they going to go down? How is that going to impact my investments? How is it going to impact my mortgage and things like that? Yes, Kiplinger is good. ARP, yes, ARP has always has good articles. And teaching your children early, getting them started early on what's a good financial habit, how to save, how to put money aside. You're never too young to plan for retirement. So it's crazy. Like, you would talk to kids about retirement, but you have to because the way the economy is and the potential for Social Security and things going forward, as much as the kids at this point, teenagers, college students can learn and start putting money away for their future, the better it is. So that's a good habit. Continue the financial literacy at all points, for yourself, your family, your kids. Okay, planning for taxes. This one is, I had a lot to discuss on this one, but we're running out of time. So I'll just go through uh, tax advantage accounts very quickly. Tax advantage accounts there's two different kinds. There's tax deferred accounts and tax exempt. So tax deferred accounts are basically accounts that will grow without you paying taxes every year on it. So the taxes are deferred until you retire, and tax deferred are usually for retirement accounts, so 401k, an IRA, and other employer plans like a 403b if you work for a nonprofit, or a 457 if you work for a state or a city agency. So those are tax deferred. Retire as you pull the money out. Then you have tax exempt accounts. Tax exempt accounts are accounts that you've created with after tax money. So your net pay, whatever you get in your bank account after you've paid and after you've paid all your withholdings, if you take money from there and you put it into a Roth IRA or a Roth 401k, those are tax exempt, which means that they build up tax deferred, but you never wind up paying taxes. So when you actually retire and start pulling the money out, there's no taxes due on those. So those are the tax advantage accounts. You have tax deferred and you have tax exempt. Um, Now, smart tax strategy, this is an important one, and I want to go through this one in a little bit more details. So for 2025 and going forward, there's a lot of tax strategies that were implemented under the one big beautiful bill, uh, which is not really beautiful bill as it was touted as being, for several reasons. So, and I'm going to clarify those. So there are individual tax rate brackets that were in effect in 2017 are still the same. So those have become permanent. So the lowest is 10%, the highest is 37%. So that will stay the same. Um, there have been deductions that are added. Those are only going to be in effect from 2025 through 2028. Uh, so you might have heard in the news where they said Social Security for only $6,000 of additional income will be deducted if you're over 65. So taxpayers that are 65 and older will be able to claim an additional deduction of $6,000, which will reduce their income. So it didn't make Social Security non-taxable. It's just reducing your total income by 6,000. Another clarification that I want to make is on the overtime pay. They were saying overtime is not going to be taxable. That also is not true. According to the tax law that was actually implemented, if you receive overtime pay, you can deduct up to $12,500 of overtime from your tax return in order to come up to a lower uh, taxable income. So only a certain portion of your overtime is being deducted. Tip income, they said tip income is going to be free, no taxes on it. That also is not correct. The tax law, when it was actually implemented, says that if you work in an area that's customarily and regularly subject to tips, you can deduct up to 25,000 in your up tip income. So income, 25,000 is your tip income. You're going to get a W-2 for $50,000. You have to report the $50,000, and then you can deduct 25,000 of the tip income. If you received $40,000 of tip income, you can only deduct 25,000. So portion of it over 25,000 is still subject to tax. So these are things that need to remember, and these are only in effect from 2025 through 2028. The senior discount, the overtime pay, and the tip income will go away in 2028. If we were able to deduct it, and then it was capped at 10,000. So the cap is now going away. So you can deduct up to $40,000 of real estate taxes, which is a big help because real estate taxes in our area is very high. So that deduction is going to help. So those are a few things that are the tax provisions that give you smart tax strategies. The best thing to do is to invest in tax-free municipals if you can. Put money into investments that do not cause a tax impact. Municipal bonds are like the perfect example. Savings bonds of the different kinds will give you a state reduction, but not at the federal level. So there are some that you can take advantage of on your state tax return. So look at that. Investing in municipal bonds is good. Charitable giving is always good. Those you can always deduct charities. Um, for small business owners, if you have a S corp or an LLC, look at how it's set up and look at the type of business that you have. Talk to your accountant or to your attorney and see if there's a way of maximizing write-offs against that different type. Because recently, tax laws have been implemented where business structures will be treated differently depending on what they are, whether they're partnerships, corporations, or LLCs. So look at that. Another good tax strategy is to max out on your retirement plans, put as much as you can as allowable by law into your IRAs and into your 401k. And if your employer matches it, go up to the amount of the match so that you can get the full match of that. Uh, so those are quick and dirty tax strategies for this year. And probably over the next couple of months, we should probably have another session that would go more in depth into the taxes, to the tax aspect. And we're down to the last slide. Habit number 10, document and communicate your wealth plan. Write all your financial goals, write all your legacy wishes. There are several books that Barnes and Noble sells, and I'm pretty sure Amazon has it as well, which has it as well. And those are basically your last wish books, and it's a book. Sometimes it's fairly thin, where you would list all the bank accounts that you have, all the investments that you have, all the stocks that you have, the properties that you have, mortgages that you owe. If you have investment properties, it'll show the location. It'll also list where the titles for the investments are, what the titles for the property are. Keep that in one location. Have your financial goals, your legacy wishes, uh, everything financial related. So God forbid something happens, your family knows where to go, where to get the information. They'll know where your will is, who has power of attorneys, or who had power of attorneys, which will now be invalidated. And that's very important to know as well. Where are the trust accounts? Make sure that you do not have your will in a safe deposit box, because the minute the bank realizes that you have passed, they will seal the safe deposit box. And if your will and your last wishes are listed in there, it's going to be a while before the court gives issues the documentation for the bank to open up the the safe deposit box. So don't keep it in a safe deposit box. Keep it at home in a fireproof case where it's handy to reach. It's always in a safe location. Have all your wishes listed, what you want to happen when you pass, where you want the funeral, where you want to be buried, who you want what to go to, what all your accounts are. There have been many instances where people pass, their family doesn't know where they have the bank accounts, and it winds up going to the state, and then the state winds up having the unclaimed properties, where then you have to search and see if there was any accounts that you were eligible to inherit and nobody knew about. So always keep that. That's very important to have that well documented, and tell people where you have the information. Tell them, I have this particular box, this particular binder or book or folder in this closet. If something happens, reach for it, and that's where everything is. So that's very important. Um, so in closing, wealth is built by habits, not luck. And they gave you very quickly 10 habits that are good to pick up, that are always good to follow. Um, Keeping these in your mind are always good. This will help you in establishing a good financial picture for yourself. Always be consistent. Continue the education, like I said. Continue the financial literacy. Tell everybody where you have your your information, and I think that's it. And that's my contact information. And again, I want to thank Z. I want to thank the Yonkers Public Library. I want to thank everybody who attended today with all the questions that you had. And I hope this was helpful, and I hope we can continue doing this. And